I suppose it's a version of, sell on the rumor, buy on the news. This is not uncommon in this kind of environment. There is a lot of short-term money in the market, algo-driven, quant-driven, and it keys off sometimes technical conditions. We certainly were oversold in some areas of the market. It can sometimes key off sentiment conditions, and we had seen sentiment really reverse. So I think it was some of that. I don't think we're out of the woods yet, though, in terms of headline risk, either associated with Russia, Ukraine, or, of course, the bigger macro force, which is the Fed.
Yeah, speaking of the Fed, is the argument that just like we saw strategists pull forward their expectations on data, they're now pushing back their expectations on geopolitics? Is that too glib?
Well, first of all, with today's action, we only saw expectations in terms of market pricing move from 7 rate hikes to 6 or so. So we did not see a big shift in prospective policy. And of course, all of this parlor game of how many rate hikes, there's very little analysis of the balance sheet component of this, not to mention that the Fed isn't operating with a predetermined playbook at this point. They have been very clear about their data dependency. And of course, the data is inclusive of something like Russia, Ukraine, and the feeders it has into energy and inflation. So I don't think this changes the launch coming in March, but it's not like we knew what the trajectory was likely to be on either rates or the balance sheet. Arguably, there's even more uncertainty now, but I don't think it changes the Fed's launch point from next month. Maybe it lessens the chance of 50 versus 25, but I think that's about it.
Lizanne, you said that we're not out of the woods yet, implying that there's more volatility to come from here. What do you think investors should be doing to protect their portfolios right now? Is it too late to engage in some of the traditional inflation-based hedging techniques, going long commodities, energy perhaps?
Well, I think we're probably in a decent secular environment for energy, just given how low a weight it became in the S&P. And I'm not suggesting we're going back to the 70s era, but we have to remember that back then energy was today's tech. It was 25% of the S&P. And we could be in a long secular cycle for commodities. That doesn't mean you won't be at the mercy of that sector in particular getting overbought. Where I think the leadership has been most consistent for the last several months, really back to the point where the Fed started tapering, is quality. And I think that quality trade, which spans into all sectors, in fact, sort of value lowercase v and quality have been the outperformers even within sectors that happen to live in the growth indexes. So value factors like strong free cash flow yield, strong balance sheets, pricing power, even hybrid factors like positive earnings revisions. I think that's how investors want to approach this market, is look for value, again, lowercase v, look for quality. And I think that will reign supreme in terms of leadership amid all of these wild swings that you're seeing intraday and sector shifts that are happening.